Welcome back. This week we have a slew of economic events taking place. Today alone, we're going to talk about existing home sales, the Fed Watch tool that we're developing, and the development in mortgage spreads, which is actually quite interesting. That in just a moment. First off, existing home sales declined 2.2% to a seasonally adjusted annual rate of 407 million. The sales declined 16.6% from a year ago. We're seeing now a little bit of a slide in existing home sales. That's new. The median existing home sales price rose 1.9% from a year ago to 406,000. And that was a fourth time the monthly median sales price exceeded 400,000. That includes last year as well. Here we see the yellow histogram bars. That is the Federal Reserve interest rates as they stand now. The blue line represents median sales price of existing homes. The red line, the sales price of single family homes. We can see obviously they move very close together. But what's notable is that they've both marked a decline, the first decline in quite a while. Blue histogram bar charts show us the active listings. The XHB is the housing market ETF that represents home builder stocks in that general industry. And we see a rather strong correlation as active listings rise, so does the XHB. However, that correlation did not always take place. It's actually logical that we'd have an opposite correlation, meaning when we have more than expected active listings or a rising active listings, the XHB goes down because active listings rising indicates maybe there's not as much demand. But now we see the active listings are rising. Now, this is, of course, updated through the end of July, not including what we know as of, or I should say, the beginning of July, not including today's market action or the recent market action, which has actually been quite weak. But if we take this inverse correlation to heart, it would make sense why the home builder stocks have been weak lately. Here are active listings in orange, inventory price per square foot in green. As the listings rise, the price per square foot declines and vice versa as well. As active listings decline, the price per square foot rises. Now, it's interesting to note that the price per square foot is now coming down for the first time in quite a while. We have been experiencing what's called the lock-in effect, where those potential sellers do not want to sell because they don't want to have to buy something else in such a high interest rate environment. But that might be changing. The strong housing market has been it's been stubbornly very strong. That looks like it's wavering though. Here's the sales price for single family homes in blue, XHB in red. Again, this is updated through the beginning of July. If we were to update this through present date, we would see that red line starting to move to the downside as the sales price for single family homes now is marking the first decline we can see in quite a while, going back to the beginning of the year. Here in blue, median sales price of existing homes versus the XHB. Again, the first decline that we've seen in a while. This shows now, again, one report does not make a trend, but today's report does fly in the face of what we've seen for quite a while. Here in green, existing home sales monthly supply, that is rising. There was a problem with lack of inventory. That looks like it has dissipated that problem to some extent. And this we would expect to see an inverse correlation. When the monthly supply goes up, like it did late last year, the XHB goes down. But it looks like as that supply wavered, the XHB started to rally. However, now it looks like the XHB is starting, or I should say, the existing home sales price, or home sales monthly supply is rising. This would weigh in on a negative way on the XHB, the home builder index. Here in gray, housing inventory. This represents the median days on the market a home will sit before being sold. In the early part of this year, we saw up to 80 days, and that declined down to around 60 days. That is now rising. It's still only around 62, but the trend is moving to the upside. It's taking a little bit longer on average for a home to be sold. Now, here, this is a new segment we're working on. It's called Fed Watch. We have a slew of Federal Reserve speakers speaking this week. And these speakers certainly can move the mark. And of course, at the end of the week, we have the Jackson Hole, Wyoming Federal Reserve Summit, where Chairman Powell will speak. That can certainly move the market. Now, you may ask, who are the members of the Federal Reserve? Well, it's made up of a board of governors. It's also known as board of governors, and it's made up of the permanent voting members of the board of governors. That is Chairman Powell, the vice president or vice chair, I should say, Bernard, Michael Baer, Michelle Bowman, Lisa Cook, Philip Jefferson, Christopher Waller. And over time, we hope to learn a little bit more about their individual stances and personalities as it pertains to interest rates and their outlook for the economy. But as they make their speeches, it really can give us some insight. Now, in addition to the voting members that we see here in red, we also have voting districts. Some of the districts vote and then they swap every year. There's a little bit of a shuffle. The voting districts in orange include John Williams of New York, Austin Goolsbee, Patrick Harker, Lori Logan, and Neil Kashkari from Minneapolis. There are also non-voting districts. Now they speak. Now they don't have a vote, but it certainly still is important to make note of what they say. Helen Merculo, Loretta Mester, Thomas Barkin, which spoke today, Raphael Bostic, and Mary Daly of San Francisco. So the update today, Richmond Fed President Tom Barkin spoke today. Now he's a non-voting member. So we have to take this with a little bit of grain of salt. This is not directly going to be taken into consideration in the next Federal Reserve meeting. However, his opinion might be shared with others. He said, in part, many things. He said, the Federal Reserve must be open to the possibility that the economy will begin to reaccelerate rather than slow, with potential implications for the U.S. Central Bank's inflation fight. What does that mean? That the economy will begin to re-accelerate. Sounds like he thinks the economy is pretty strong. He says also the Federal Reserve could lose credibility if it were to consider changing its 2% inflation target before achieving that goal. The Federal Reserve has a 2% inflation target, meaning they're going to continue to raise rates until inflation comes down to 2%. Inflation currently is roughly around 3. Taking this, on face value, it indicates that Federal Reserve is more likely to raise interest rates or to continue to raise interest rates until and only when we hit that 2% inflation target. 2% inflation target, it was enacted, I believe, under Ben Bernanke around 2012. And the Federal Reserve must, according to their own mandate, keep inflation around 2%. So again, this is a non-voting member, Richmond Fed President Tom Barkin, but if you take his opinion at face value, this indicates the Federal Reserve is likely to raise interest rates next September. Well, they weren't specific, but definitely in the future. Now, on the left-hand side, we see the black line is the 10-year bond. The red line is the 1-year bond. This is 2007, 2008. On the right-hand side, that's present day. The red line is a 1-year bond. The 10-year is the blue line. On the left-hand side, the 10-year, we can see. Now, there was an inverted bond market at the very beginning of this chart and further back in time, early 07, late 06. That inversion went away when the 1-year bond crossed back below the black line, the 10-year. And we can see the 1-year bond, if we overlaid this with the stock market, we would see the 1-year bond chase the stock market lower. The 10-year bond moved down slower. But the point being is that in 2008, and we spoke about this yesterday, in 2008, the inverted bond market ended when the 1-year crossed back below the 10-year and moved down. The 10-year at one point, was much higher. Now, present day, we have the 1-year in red at 550 roughly, the 10-year at almost 450, around 430 or so, which is actually multi-year highs. We haven't seen the 10-year this high in a long time. What's interesting though is this contraction, the dissipation almost the disappearance of the inverted bond market, not yet, but it looks like we're going that direction, is not being caused by the red line to go down as it did in 2007, but rather this inversion is closing as a result of the 10-year bond going up. The 10-year bond, maybe according to the bond market, the signal the bond market's telling us is that the 10-year bond is sending us the message that the Federal Reserve is going to keep pat with their interest rate inflation target of 2%, or their inflation target of 2%, and therefore continue to raise rates aggressively until and only if we get inflation down there, which means it translates into higher interest rates. And also, the Richmond Fed president today said that the economy looks strong. It looks like the 10-year is starting to agree with him. Well, with that spread, it's very important to talk about the mortgage spread. The comparison of the 30-year average mortgage rate versus the 10-year U.S. Treasury. The mortgage spread basically shows us the amount of risk that the banks are building into the mortgage. You see, when a customer goes up to a bank and says, okay, I want to buy a house, I want a mortgage, the bank will say, okay, well, how much is the 10-year treasury on? The treasury bond paying right now? Okay, well, we're going to, what's the 30-year paying right now? Okay, we're going to give you a mortgage at X interest rates. But we're not going to give it to you the 30-year treasury rate. We're going to give it to you the 30-year treasury rate plus a little bit more. A little bit more is their insurance in case the economy turns bad. Basically, according to their actual tables, the chances a customer may not be able to pay back the mortgage. That extra insurance is the difference between the 10-year U.S. Treasury and the 30-year mortgage. That mortgage spread represents how much extra the Federal Reserve is baking into the cake, so to speak. So, for example, the blue area chart in the background, that's the 30-year mortgage. That's the flat 30-year mortgage. The red histogram bar is a 10-year treasury. The difference between the two, and of course the 30-year bond is above the 10-year, but the difference between the 30-year mortgage rate and the 10-year treasury is the white line. That's the mortgage spread. And it's important to note that during times of economic strife, the mortgage spread rises. It means that banks are they're adding in a little bit of extra insurance to protect themselves. So when stock markets go down and there's a little bit of trouble on the horizon, like we saw late 22, early 23, that mortgage spread hits levels around 3.2%. Again, 3.2%. It's very simple. It's a 30-year mortgage minus 10-year U.S. Treasury. Right now, we have mortgage spreads around 2.7%. So relatively speaking, now this is actually very high, but relatively speaking, meaning over the past couple months, it looks like it's lower. But my opinion is, well, this is in part, of course, due to the banks maybe tightening their mortgage spreads, or reducing their perception is reducing a little bit of risk. But it's also because the 10-year treasury has been so strong. Notice a 30-year mortgage, yeah, it's ticking up a little bit. But if we were to look at this on a percentage basis, a 10-year has been on fire. Now here in the purple area chart is the mortgage spread. Again, we hit very big levels around 3.5%. The red line is a 10-year treasury. The 30-year mortgage is in blue. This goes back to 2014, and we can really see. And remember, March of 2020, this spike over here represents the worst part of the stock market crash during the COVID crisis. We had not even a 3% mortgage spread. We've now pulled back to over a 3.2% mortgage spread. So even when it feels like it's pulling back, as it has now, take that into consideration. We're still probably in a worse position, at least according to the perception from the banks. We're worse off now than we were at the depths of the COVID stock market crash. Here, going back to 2014, we can see the red line is the S&P 500. The black line is a mortgage spread. We see an inverse correlation. When stocks rise like they did in 2019, the mortgage spread was very low, below 2%. When the stock market crashed, mortgage spread goes up to almost 3%. Well, we're higher than that now, or just around 3% now, as the stock market starts to weaken. If the stock market continues to weaken, which, it's been weak lately, I know the charts, it hasn't, collapsed, but a lot of issues within the stock market. A lot of stocks are really starting to fall apart. So, take a look at Dick's Sporting Goods as an example today, if a stock that was down a lot. Um, you'll see mortgage spreads, I think, rise if the stock market continues to go down. And by the way, historically speaking, this is what the average mortgage spread looks like. The months January, February are the x-axis that goes across with the average of the entire year. And then we have, of course, on the right-hand side, again, the average, and on the left-hand side, the year-by-year average, or count, I should say. So, for example, February of 2014, we had a 1.58% average mortgage spread. That was the average for all of February 2014. The average for all of 2014 was 164, then 171, 181. 2020, we had the COVID crisis. 223 was the average for the whole year. A little bit back to return to normalcy in 2021. By the way, I believe the 10 or 20-year average of mortgage spreads, it's below 2%, if I'm not mistaken. I think around 1.7%, at least up until lately. However, 2022, the average mortgage spread was 235. Starting off June of 22, we saw the beginning of the inverted bond market. Take a look at that's when the average mortgage spreads really exploded. 162, January of last year, 180, 193, 215. May, June, the beginning of the inverted bond market, 233, 232, and we never looked back. January of this year, 275, 291 in March, 297 in June. We've pulled back, 279. That pullback, that's only as good as October of last year. It's not really a pullback. Our average for the year is 282. So point being is that the banks are building in a lot of risk into the mortgage market. So despite what Richmond Fed president, may say about the economy being strong, maybe he's looking at something that we're not. Sure, he is. But despite the fact that there seems to be a lot of optimism from a lot of central bank figures, and a lot of earnings look good, a lot of earnings also don't look good. And the banks, we can take them at face value. They're building in a lot of risk into the mortgage spreads. And now we see existing homes are starting to waver despite the higher interest rates. It looks like sellers are becoming a little bit more aggressive, at least more aggressive than they have been in the past couple months. We have a lot more to talk about this week. And of course, the Federal Reserve Summit, Jackson Hole, Wyoming, at the end of the week. Chairman Powell will speak, and we're going to keep a close eye on the economic market and the economic calendar and the market behavior as well. We hope this has been helpful. We look forward to seeing you back soon.